Hi, welcome to Market in a Minute. Trump's 145% tariff. When I first saw that, I'm like, oh, what a big mistake. And now I'm thinking, this might be genius. So it's brought the Chinese to the table. Their economy was blowing up. So I think they could negotiate a really good trade deal. And it could be really good for our economy over time. We have more confidence in the 2026 earnings estimates for two reasons. One, the GDP growth in the first quarter was better than we thought. Sure, there might be some problems with the tariffs that were in place for about a month and a half now. So that might be somewhat of an issue for the second quarter, and just the economy being generally a little bit slower, kind of frozen up because of that. But as we go through the year, I think the economy is going to reaccelerate, and those 2026 earnings may be about right. And then finally, the negative sentiment is so negative and we have lots of cash. So negative sentiment and cash, it's the recipe for a nice cyclical bull market. The CPI is on Tuesday and PPI on Thursday. We think that it probably will come in line with consensus or maybe a little bit less. So we're looking for up 0.3 on CPI, and then the year over year up 2.3%. So that's pretty much in line with what the Federal Reserve was thinking, what their goals are at 2%. So without the tariffs, the Fed could actually cut rates. So if we don't have these tariffs in place, in their mind, driving up prices, well, it's time to start cutting some rates and get the housing market back on track. So the killer to CPI has been oil prices. So you can see here, oil was up almost at $84 a year ago, and it's down below 60. So that's roughly a 29% drop in oil prices. Oil is so important to inflation. So this is going to have a big impact on inflation as we go forward, as long as oil prices don't spike up for some odd reason. The other main factor is shelter. So shelter is up about 4% in price in March. We think that shelter is actually flat to down. So as rents and home prices level out and actually probably are going to go down a little bit, this will be a nice benefit to CPI. And it's not, I don't think that the Fed's actually focused on how good the inflation numbers kind of below the surface actually are starting to look. President Trump goes to the Middle East this week, I think twofold. One is to make sure there's plenty of supply for oil, and secondly, if they go after Iran. So I think that's set up. He's going over there to be diplomatic, let everybody know what their thoughts are on Iran. So when they do it, nobody's surprised, and there's plenty of oil in the market, so we don't get a spike. M2. So M2 is really what ultimately drives inflation. M2's been going up at only 3.7% over the last 12 months. Keep in mind, it was up 42% from the bottom to the top during COVID with all the stimulus that was added to the money supply. So 3.7%. You can't get much inflation out of that. You're going to get GDP growth about the same level, nominal GDP growth about the same level. So there's not much inflation in those M2 numbers. Now the market outlook. So we'll talk about this in some more detail in a second, but the technicals have turned up. We think the tariffs being lower takes the risk out of the economy and the earnings estimates. So if we have any sort of negative impact from the tariffs at this point, I think the market will look through it and believe it's not a big deal as things are getting resolved. All the big investments coming into our country, that's going to drive GDP growth to be really strong. Keep in mind that GDP is about $30 trillion, and I think we're up to $8 or $9 trillion. So that's almost to the point it's a 30% of the economy that's going to come over the next several years in terms of growth. So you could be really positive on what we're seeing on the adding supply into our economy, keeping inflation down, but having very nice GDP growth. Tax cuts are coming, so that gives us confidence in the back half of the year as those hits. And hopefully we have a lower federal deficit. I say hopefully. So if that hits as well, then there'll be less pressure on interest rates as well. So as I mentioned, we're more confident in what we're seeing on the earnings. As you look at the 2026, here it is $300 for the S&P. It's come down, and also 2025 has come down about $10. So it was 275, now it's 265. We think somewhere around 260 might be the right number. That's pretty close. So that's minimal in terms of earnings risk in all the individual companies in the S&P 500. So I think the market can get more comfortable that we're going to hit those numbers. Now the only issue is we're already at 20 times earnings. So you can see the PE multiple here at 20 times. In the late 90s, early 2000, we were at 24. If this is the big golden age, right? Low inflation, good growth, you could easily get back to 22, if not higher. We think that the market trades between higher than the 18 that we were, somewhere around 19 to 22 times earnings, which gives you still some nice upside in the overall markets as you look out to next year. I think valuation is really important. So it's key to buy reasonably valued stocks. However, some of the open-ended stories, now that they're down, you can play those for a nice trade or nice investments. So there's a number of open-ended stories that we've been looking at, and we talked about Mobileye, for instance, and I even think the quantum computing might be an interesting place to put a little bit of money as well. As we reaccelerate in this year, I think the market will rotate down towards the things that are cyclical, that have been overly beat up. So some of those cyclical names could have really big moves. The technicals of the market. Hopefully you can see these charts. So I know they're kind of small, but this is the S&P. And this is what I really like about our tactical algorithm. So as we break the 20-day, we start to get a little bit more defensive. See it right there's the 50-day, we become more defensive. And then as we break the 200-day, we want to be very defensive. And then as we come back out of this, we actually were using that oscillator, the overbought, oversold oscillator. And as you can see, as we go back up here, here's the 20-day. And so you'd be buying. Here's the 50-day, you'd be buying. Now above the 200-day, you're fully invested or reasonably fully invested. We're right about 75% invested currently. So we're not fully invested. We're keeping a little bit of dry powder. That will be put to work as we go a little bit higher above that 200-day moving average. If it doesn't hold, then we're going to reverse the whole thing. But I think it's going to hold this time. The NASDAQ, similar story, bigger bounce. So it's a little bit higher off the bounce. So it went down more and went a little bit higher. Where we see the value in the market on a technical basis. So what could maybe heat up some more is a Russell 2000 IWM. We're playing IWMI. It's got a really nice yield on it as well. Doesn't go up quite as much as the Russell 2000 does on really strong days, but it keeps pace nicely. You can see here it broke the 20-day above the 50-day. It has not gone above the 200-day, has not gone above the 100-day. So we're thinking, okay, for risk money, you need some exposure here. And this could be the area of the market that really does really well as we go potentially in this cyclical bull market. In terms of wealth management, really simple. We like the baby bonds. So if you need income, what baby bonds are, they're smaller tranches of still good companies, but they're just smaller tranches. They're not 500 million to a billion in size. They're 25 million to up to 100 million in size. So they're smaller. We focus on just the investment grade companies, so triple B or better. and then 5 years less in terms of maturity, you can get 8%. So that 8% return might be really competitive this year. And then the income stocks, we've talked about this a lot, but just to reiterate, we like the mortgage REITs, the agency mortgage REITs, where they're earning a lot more than what they probably should be because of what the Fed's doing currently. Their return on equity, I mean, it's about 20% at this point. So really high numbers. Closed-end funds, there's a number of closed-end funds that look, attractive at nice discounts to their NAV, plus nice dividend yields. And then deep value cyclical stocks. These have been really tough through this market. That some of them come down, 50%. So just to get back to even, you need 100%, right? Some of them yield, 6-7% big yields. And as the economy improves in the back half of the year, we think that these will come back into favor. We think technology looks actually pretty good. So it's corrected a lot and, took the cloud off of it. I don't think the same stocks will necessarily perform the same. I don't think NVIDIA is the make all and be all to the technology market. I think Microsoft's probably run quite a bit. Google has a cloud over it. I can't believe we missed Tesla. I just can't believe it. We had the thing in our sights and we let it get away from us. But we like autonomous driving. So Tesla is going to be a big play on that. Mobileye is probably one of those open-ended stories where you could get not only up back to the old highs, so it's roughly $16, $17 currently, not only up to maybe that $35 range, but as this heats up, the fundamentals are now better than they were, say, a year ago when the stock was $35. So this could have a big run. So this is kind of our way of playing that, that trend, that huge trend that we see on autonomous driving for the next several years. What else looks good to us is that the banks, strong fundamentals, that's good. The stocks are still cheap. They're off their bottoms, but they're still cheap. Don't buy JP Morgan. Buy the second tier of the really good banks like Bank of America and Citigroup. And if you have to, Wells Fargo, not my favorite, but Citigroup and Bank of America look really good still. Factory automation, with all this money coming into our country, we don't have a lot of labor. Our labor's not cheap. So they're going to build these factories to have a lot of robotics to them as well. So we like that swerve as a theme. Basic industries, I mentioned this, those cyclical stocks have been creamed. Those could come back very nicely with nice dividend yields. Housing is the play probably for later this year and into 2026. Those housing stocks have been decimated. Big upside in those. There's a shortage of housing. So as interest rates come down, we think that new home sales are really going to percolate, and their new home sales prices are about even with existing homes currently. Also, the consumer stocks. We like consumer stocks. Everything but Walmart and Costco. So those were the safe havens. Now you want to start to move down the food chain a little bit. We mentioned Gap before. Gap's one of our favorites. Lowe's for a play on housing. That's another really good way of playing this. So as we get through all these negativities with the tariffs and we're on our way, as we see the lower taxes, short-term rates coming down because there's really not a whole lot of inflation in the economy currently. The Fed's going to have to cut rates to be more in line with the bond market. We see those small cap stocks ripping to the upside. Grail, as I mentioned to everybody before, this is a great, hugely open-ended story. The stock's been 15 to 60 this year. It's about in the middle part of that. Could go easily back to 60. They report earnings tomorrow, so after the close. So if you're interested in stock, get on an earnings call. Otherwise, I'll update everybody next week. So, China is less bad, which kind of sets the stage for everything kind of improving from here. Actually, China actually benefits the energy stocks a little bit. So just keep that in mind that kind of, I think the swing from negativity to the positive is on its way, lots of cash. The estimates look pretty much there for next year. I don't think there's going to be a lot of cuts for next year. We're pretty close, something like 285 in terms of earnings next year, and a 22 multiple gets you somewhere in the low 6,000, 6,200, 6,300 for the S&P. But the big move is going to be down below all that in the smaller mid caps in different industry groups. So if you ever need anything, ping me. Come to my website, Patrick Adams CFA. Sign up for a hard copy of Market in a Minute. There's a lot more detail than these videos. So sign up for that. We'll send that to you every week. And if you need help on your investments, we manage tactical portfolios. Actually, we did a really good job, I thought, managing this volatility. And some of our customers have reached out to us to express that. We thank you very much. Your appreciation is very much noted. And so we manage these tactical portfolios that defend against downside in the overall markets, but still getting really good returns on the upside. Take care.